high debt level, just don't like it. Lower ROEs, about 6% from our calculations, and it's just we didn't like the mining industry as well. Yeah, sorry, we just did not like this company at all. You guys had about 200% return on your equity, and we just think it's going to be coming back down here in the next year or so.
All right, so a bit about the company. They're one of the largest producers of silver. They do gold, lead, zinc. They're one of the oldest publicly traded corporations, established in 1891, right near Coeur d'Alene. Hecla has operations based off of 4 mines: Greens Creek, Alaska, Lucky Friday in Idaho, Gaspari in Quebec, and San Domingo in Mexico. So they got a little bit of diversification there with Canada, US, and Mexico. We have a quarters 5/4 analysis here. We have rivalry among competitors or among producers. Rivalry is high because there's limited amount of suitable mining grounds, and the companies that have the largest reserves have the most power in the industry. Hecla's reserves were 6th largest. That going for them. Threat of substitutes is low because it's a precious metal and there's not many good substitutes for precious metals. Threat of new entrants is high financing costs, and again, the limited mining grounds. Bargaining power of customers. Hecla is a strict price taker, so they've got to take whatever the market gives them. Power of suppliers. Government regulations can get in the way, and permits are hard to obtain. Competitive strengths that Hecla has going for them: they do have the highest reserve grade among their competitors, which means that they can produce at a lower silver price than other producers, and they've got long reserve life. They've got a couple of mines that are going to be working for the next 20 years. They have undeveloped resources in Rock Creek and Montanero. And they have San Sebastian, which has provided great IRR of 1,000%, good return on investment. Silver and gold prices, which is a very big part of the valuation. We've seen the dollar strengthen recently, and if that continues, that is going to continue to drag down the price of silver. And investment, we expect markets to continue on an upwards course, leading to an underperformance in the precious metals industry. Demand, modern demand is picking up for silver, so that's something going for them there.
All right, excellent. So back to this ROE that I dislike. At 6.23, net profit margin for Q3 is 14.3%. Because it's so asset intensive, got 0.3 asset turnover, which really drug this down. Leverage ratio of 1.63, coming out as 6.3 ROE. Just don't like that. For our forecasted EPS, for the last 5 years, I don't know if you guys can see this, which is a shame. Cost of revenue has increased to 8.9% year over year, which is going to kill their margins. We're going to hit by 2018, 2017 this year. Total revenue has been growing out every 1% is our growth rate, and 5% here in the next 3 years, a negative 5% growth rate. So we're just not seeing the outlook that other people are seeing that reflects the price right now. Given the outstanding issues, weighted average cost of capital is about 10%, 9.75 to be exact, right over here. 4.1% for a debt, not bad. Cap was a CAPM model, 12%, and one of those weighted is 9.75. Just a little breakdown of how we got our cost of equity. We assumed the risk-free rate was 3.5%, and the risk premium was 6.5. We want 10% from the market return. For our beta, we got 1.3. This is a quick little, I guess, breakdown of how we got this. We got the 10-year covariance of the company and the SPX variance for the weekly, about 1.9, 1.299, 1.3. For our discount DCF model, stock value per share is 0.7. Now, we brought this up, but we were being very generous with some of these financials, and it just wasn't working for us at all. Negative 5% 3-year growth rate, that's really going to be because of that. Metals going down, interest rates going up. That's into the revenue. Long-term growth rate of 3%, just because of inflation. Free cash flow for this 2016 we estimated 51.06. And with the outstanding shares, it breaks down to 79 cents for our DCF model. Our PE method was slightly more generous. With the 10-year beta that we showed, we got 1.3. Forward PE ratio 17.3i for the S&P 500. Risk adjusted 13.3e for the PE target. When we break these down, we did a 50-50 between the PE method and the DCF analysis. We looked at the price to book method, and it just wasn't giving us a really good look at what the company was at right now. Weighted at 2.06 for the shares. Their debt is, I'm not lying. Interest rate coverage was 6.86. This was as of Q3. That's terrible. So they're having a debt problem. Are they going to be covering this here in the next 5 years? I don't know. But it just doesn't look good right now. Debt to equity 0.35, so they not have a lot of leverage right now. Okay, so just to summarize this, we're selling it. We're selling it all the way. Short it, in fact. Short it. No, it's flat. Please.
I like the courage.
Okay, I've got 206. Just quick summary. Low ROE of 6.4%. Don't like it. High debt. Low interest coverage. There you go, guys. So a little different. So do we have a quick break here?
Yeah, well, it's now for the judges for questions.
Okay.
So it seems like a lot of what your sell recommendation is predicated kind of on macroeconomics in terms of the Fed slowing their purchases, which will continue to increase the dollar, and stability in equity markets, which decreases demand for gold and silver as a hedge. Is that my understanding?
Most certainly, that's exactly
Okay,
right.
so did you guys think about the fact that maybe you're wrong on that in terms of Donald Trump in the administration, a lot of his tweets and language in terms of future international trade could create global concern and slowdown in the equity markets, where you would actually potentially, or to the point where actually international, other banks around the world want to move out of the U.S. dollar, weakening the U.S. dollar at the same time that individuals are looking for safety. Like, is that factored in your model?
You know what? We had to take an approach on this company. We weren't going to be a hold, though that may be a more rational and moderate approach. We wanted to pick a buy or sell. What does this company go for? And we just picked the side that the dollar's going to strengthen and people are going to be moving moving into the dollar and strengthening interest rates. So that's the approach we did for our model.
Okay.
So we kind of went all the way on this.
So if you're going to be short too, you obviously probably want to, my concern would be that you want to look at M&A activity in the space, because if you're short and if M&A activity is, previous deals have been done with Hecla equivalent valuation of maybe $10 or $12, did you guys look at that risk of recommending a short that this thing can maybe get taken out, or not? Maybe if you look at M&A activity, maybe it's worth $3. I don't know, but did you guys look at that at all?
No, I did not personally, and I don't know if Steven did.
Going forward, if you're in a shorter position, that's something we'll definitely.
Okay, perfect, thank you.
So good question about the debt. You say it has a variable rate. How does that work? What kind of debt instrument is it?
I was gonna say, this was Steven's valuation.
The wrong one of the bus.
No, it's true, yeah, I'm not too happy with him.
We haven't been able to get a hold of him for days.
But see, so I'm not gonna answer that. No, it's true. So I'm not gonna be able to answer that one for you.
I guess maybe parallel or one step back. How much of their debt is floating rate versus fixed? Because interest rates don't matter if it's all fixed for the next 30
Yeah,
years.
totally.
So how much exposure do they have to interest rates?
No, I was talking to Steven before he left us. No, and from what I understood, it was around 40%. That's what he was telling me. Now, do I know if that's correct or not? Do I know if Steven's right? Well, if he just left us, I don't know. But, so I can't answer that one for you either.
A lot of the metrics you guys seem to be pretty negative on in an absolute term, like their ROE, their asset turnover. How do those compare to the industry though? I mean, all
Totally
extractive
on
are going to be, more similar than comparing it to the full S&P 500.
Oh, 100%. Yeah. Versus the industry, it's on par. And in fact, there are some points where it's better. But the industry sucks. So we're just selling it, and we wouldn't be putting money in this industry or the company as well.
So if it's a low ROE business, you need to use leverage to increase your ROE.
Right.
Would you never invest in a grocery store chain as well? Or
No?
and there's a lot of low margin leverage businesses that are
Yeah.
beyond mining.
No, totally, and you can do that.
Mhm.
But there are also better investments that use leverage that really turn a better
Have a
profit.
more consistent revenue stream.
Right, and these guys don't, they're just up and down, up and down, up and down.
Mhm.
So that's why we're not a fan of this, it's just,
So what commodity prices did you use for your valuation?
gold, silver, and we use,
At what levels?
what levels? 70% for gold and silver.
Dollars. What was the value of the gold and silver?
I would say 1,300 was for gold, and silver was at 14. I don't remember the silver, but gold was around 1,400.
Did you guys look at insider buying at all in terms of, once again, if you're short? Thing that I've always said as a research analyst is I never know more than the CEO or CFO.
Right.
And so if they're getting their checkbook out and buying the stock themselves, you better have a really good case. Did you guys look at insider purchases, whether or not, it's on the flip side, were they selling their stock, where they kind of improve your position?
I didn't look at it. Okay, perfect.
So you're also concerned about their debt, but so where's their break-even commodity prices where they could no longer cover their interest service their debt? So if you were, especially since you're so bearish, when do the bondholders have to start worrying?
Yeah, well, we found that they have junk bonds. So with the high debt, so at least that is what we had discussed with valuations. So with 6.3%, it's not bad from just looking at it, but when I was talking to Steven, and this isn't on him, this is on me, totally. And we just found that bondholders were just not getting what they needed.
Because I guess it seems to contradict maybe a little your ore grade quality. You said they had the best ore grade quality, which would make me think that they would have more buffer until they ran into problems servicing debt if they can extract it cheaper than competition. So as a relative value to other firms in the industry, would they be, is this the best horse in the glue factory, or is it just any old horse in the glue factory?
I would say it's certainly the best horse, but it's, yeah, I know, we just don't like it. We're not liking this at all. We're getting out of mining, man. So, best horse in the glue factory, yes. And it's not like it's all negative. Our financials, yeah, we think they're negative. But the more intangibles, yeah, they have good ore quality. Yeah, they have the land in Montana that still has a bunch of upside, but right now we think it's really bearish.
So putting on a different hat, in the sell hat, why do you think some people would be interested in this? Did you see any positive?
If you have a different assumption on the silver prices or the dollar strength or volatility, then you would take a different course in evaluating it. Because if the price of silver goes up, then obviously their leverage works in their favor.
Or the dollar weakens. Certainly. Oh, you picked one side? There's it.
So since it sounds like you're equally bearish on commodities, why, or would you recommend going short on the commodity instead of going short on the stock to, limit your exposure to market dynamics? If, there's a strong bull market, you don't get caught in that short versus, dislocation in prices of commodities versus the stock price?
Certainly, you could hedge it both ways. You could go on commodities or short stock, whatever you. Yeah. Oh, yeah, certainly. And it's just a different approach to this hedging. For the company, we decided to short the company instead of longing it and shorting commodities.
Do you think as well, in terms of given the Trump administration, that there could be a pretty aggressive easing of regulations of the industry in terms of the EPA that would save them a lot of money that would ultimately trickle down to the bottom line and kind of get you squeezed in your short position?
Possibly. Honestly, with Trump, I have no idea.
I'm
I'm not gonna lie.
That's the answer.
I just have no idea. So that is certainly true.
And that's about time. Thanks, guys.
Thanks, guys.
Good job.
Yes. Yeah, that.